the system really was designed, in theory, to handle anything you want to throw at it. And specifically, anything you want to throw at it.
Right.
Like when you think about attack vectors, like one of the potential attack vectors is to artificially inflate the price and then try to crash the price. And so, like, this isn't something that was uh, not only not planned for, like, this is expected. Like, if anything, this is what the protocol is designed to handle. So the fact that
Right.
the test is just so large because the order of like there was literally 4 or 5 times like the total market cap of the system that came in just a few hours. Like, the test is a big test, but at the same time, and we don't say this lightly, Beanstalk is designed to be resistant to attack from governments. It's designed to be resistant to Soros type attacks. It's designed to be resistant, period. So it's just very exciting to see and to also have the opportunity for Beanstalk to show that even in such an infant state, even with such an unsustainable period of growth for a couple of hours, even with all of that capital immediately leaving the system fights on and the system lives to fight another day. And eventually the peg will be returned. And at that point, the system is going to be in a really, really, really good position moving forward. And that's what excites us now.
Welcome to Mission DeFi with Brad Nickel, where we explore projects in decentralized finance that are innovating and driving our mission of financial freedom forward. Thank you for listening. If you like what you hear, please subscribe, rate, and review Mission DeFi and spread the word by posting a tweet to the show. All opinions expressed by Brad Nickel or his guests are their opinions and do not reflect the opinions of Black Knox, Material Indicators, or any other affiliated organizations. You should not treat any opinion expressed by Brad Nickel or his guests as an inducement to make a particular investment, follow a particular strategy, or become involved with any project. A project being featured on the show is not an endorsement of that project in any way. This podcast is for informational purposes only. Now, here's Mission DeFi with Brad Nickel.
I'm excited to have a fairly new project on the show today. We are talking about Beanstalk, which the core of the project is an algorithmic stablecoin. And I have the team from Beanstalk, Publius, here with us today. And I want to welcome you guys and thank you for coming on. And I can't wait to kind of talk about the value proposition and what you guys are creating. But if you could first kind of give us a little bit of background about how you got into crypto and then, the origin story of how this whole thing came about and why you created it.
Sure thing. So first off, thank you for having us on, Brad. It's a real pleasure. So, and we appreciate you offering this platform for us to share a little bit of what we've been working on. So we're a team that has been in crypto in varying capacities for almost 5 years now in our varying capacities, and kind of stretching from like deep economic analysis on tokens and more on the investment side of things. And then also, some of our team members, as evidenced by the code and the development side, are deeply technical on the smart contract development side. So we've been, the team has known each other for an extended period of time. And about a year ago, as ESD was really blowing up, it became evident to us that this was a real place that the market placed a lot of value in as something that the market needed, specifically a decentralized algorithmic stablecoin that was not backed by collateral. And that was also evidenced to us by like the frenzy around ESD clones like DSD and TSD. And then ultimately, in March of this year, when Fei launched at almost $2 billion committed capital when they launched, the market kind of reinforced that this is a really meaningful thing for cryptocurrency and the DeFi space to continue to grow. So we were asking ourselves around Thanksgiving of last year, where can we really, we were looking for something to really put our hands on and build. And we asked ourselves, what are the biggest problems in the crypto space to solve right now? One is obviously scalability, but frankly, that's a little bit above our pay grade. And it seemed to us that the second biggest opportunity and the need in the cryptocurrency and DeFi space was a decentralized algorithmic stablecoin. And so ultimately, we set down that path. We originally thought it would be a couple months' work to make some slight modifications to the ESD design and fix some of their, what we would call tragedy of the commons issues, where some of the game theoretic design was flawed. But ultimately, we basically couldn't help ourselves, and it ended up becoming like an all-consuming, all-encompassing, built from everything, totally our own and original. So it quickly became an all-encompassing thing where, we basically realized that A, we had a lot of potential, and B, we felt an obligation to give this really everything in our power to give it the highest possible chance of success possible. So that ended up being about 9 months or so of development and working on the white paper and getting everything set up. And about 50 days ago or so, we finally deployed the contract to the Ethereum mainnet.
Okay, so you were saying, and I'm going to make sure I understood this. You guys started off kind of saying, okay, can we take the existing contracts from the ESD project and tweak it, make it better, fix some of the game theoretics, and then we'll get something out in a couple of months. And instead, you guys ended up basically starting from scratch, or continuing down that path, but just doing a whole lot more to what you were creating.
So and this does start to get into a little bit of the mechanism design, but if you look at something like ESD, very simply it says that when the price is too high, increase supply, and when the price is too low, try to decrease supply.
Right.
And so that really was the starting point. So it's not fair to say that we started from scratch.
Sure.
From an economics perspective, but once we realized what our vision for what the system should actually look like consisted of, it ended up requiring sort of a ground up reimagining of the entire system.
Nice.
with the starting point being, increase supply when the price is too high and decrease supply when the price is too low.
Nice. Okay. So I think that's great. And I think there's a lot to be said for utilizing other open source code, but I think there's also something to be said for not inheriting other people's technical debt, but also being able to understand exactly what you're creating from the ground up. So I think there's value there. I think it's important. So we have a wide variety of listener types here on the show. We have, full on degens that don't have any idea what they're investing in. They just throw money at high APRs. We have technical people, project leads, a lot of project leads that listen to the show. And so they'll really understand at a technical level. And then we have just kind of casual investors and people who are enthusiastic about the DeFi space, and they follow another project and started listening to the podcast because we interviewed somebody. But I think one of the things that people need a better explanation of is really kind of theoretically how algorithmic stablecoins work, right? You talked about increasing supply and decreasing supply to alter the price to get it closer to its peg. But can you explain for people why that works? And I think we're seeing more and more projects trying to, not just in the stablecoin arena, really trying to utilize human psychology to influence how a particular project performs. But I'd like to, if you could kind of give us a bigger picture look and then climb into Beanstalk and what you guys have created and why you think it's better.
Certainly. So the starting point is, what is a stable coin? And there are obviously a wide variety of different stable coins already on the market. So a stable coin is just any blockchain-based asset that is designed to retain a market value equivalent to a non-blockchain native asset. So by far, there seems to be the most demand for US dollar stablecoins, and this is almost certainly because the US dollar is the global reserve currency and is used all around the world. And so there's a high demand to bring US dollars onto the blockchain. But of course, because dollars don't exist natively on the blockchain, there needs to be something to bridge them onto the chain. And so in the case of Ethereum, uh, so there are two other, in addition to purely algorithmic stablecoins, there are two other collateralized models. The first being the Tether and the USDC model, where basically a private company says, we're going to issue on the blockchain like a USDC for every dollar that we hold in a bank account. And therefore, you can, as long as you trust us who are holding the money in a bank account, you can basically get dollars on the blockchain. And on the one hand, this offers really high utility, and it is by far the most popular version of a USD stablecoin today, with over 100 billion of these types in existence. But it really does present a fundamental weakness, which is the reliance on a centralized party to administer the system. And given the current regulatory picture, and there seems to be a large desire on the part of regulators to give crypto a really hard time in a lot of capacities, in the long run, this doesn't really appear to be a solution. So the market is actively looking for a way to replace the reliance on collateralized, centralized USD stablecoins.
And I think one of the other things that's been talked about a lot lately relevant to USDC is that they can actually blacklist wallets and addresses on the chain and not allow people to participate in transactions using USDC, which in effect, because of the dependency on USDC, could have a dramatic impact on a lot of DeFi projects if regulators force them to blacklist projects. So I definitely think that's another big concern we all should be really thinking about. So I'm always glad to see more algorithmic work being done on the stablecoin front.
Just to wrap up that point and kind of introduce one of the aspects of Beanstalk is that we've really gone and done everything we can to make this as decentralized and become more decentralized over time. But one of the design decisions directly along what you're talking about with blacklisting potentially USDC from addresses is that we didn't build the oracle for the bean price from a Uniswap pool that trades against USDC. Instead, we built it using two pools, the USDC ETH pool and then also the bean ETH pool. And then by comparing the ratio of beans to ETH and USDC to ETH, we can derive a price for a bean, but without exposing it to, the operators of USDC. So to go into DAI now, DAI offers an interesting alternative whereby you can basically add value, and actually the collateral that they allow you to add isn't necessarily decentralized, so there is some level of centralization still with DAI, but ultimately you can add collateral to a CDP, collateralized debt position, and then mint DAI against your CDP. And the idea being that the smart contract enforces that at least 150%, your DAI value against your CDP will be collateralized in the smart contract, and therefore, there's a guarantee that there will always be more assets backing the DAI. But the problem is, of course, this is very capital inefficient, and in practice, who can say what the actual market size for this is? But fundamentally, having to lock up Ethereum or another Ethereum native asset to create a USD stablecoin is not really a good solution. And that's evidenced by the really high borrowing costs to use DAI. And in practice, if you look at the high borrowing costs for both collateralized stablecoins that are operated by a centralized operator and something like DAI, which is a little bit more decentralized, the borrowing cost for both of these types of stablecoins is effectively cost prohibitive. So if you think about like what could be done, like for example, I said we got into crypto around 5 years ago. One of the things that was promised was Augur, and all sorts of really interesting decentralized betting markets were potentially one of the main use cases for this technology. But fundamentally, if you have like 20% borrowing costs on your underlying asset, that basically changes the math on what is a cost effective bet to make. And therefore, basically, what actually is a market that you can make on Augur is drastically reduced. So, something, and Beanstalk is designed to do this, but something that can radically change the tide and basically make the holding or the opportunity cost for just holding the currency near zero is potentially a really meaningful fix to bring a lot more of this technology into a range where it's financially viable, even if it's technologically viable. So that's kind of the lay of the land as it currently stands. And that's also the opportunity that Beanstalk sees as what we're looking to really disrupt. And the opportunity to offer, and we'll get into it, but instead of paying like really high borrowing costs, I don't need to tell you what the cost is to borrow a real dollar in the physical world today, but to be paying orders of magnitude higher to borrow a dollar on chain is just fundamentally wrong. So the goal is, how do we flip that
Yeah.
dynamic?
Now let's talk about how Beanstalk functions and why it's different and why you feel like it's a superior model. And then kind of let's walk through the other components of the protocol and the platform after that.
Great. So fundamentally, the the way Beanstalk works and the way it has worked since it was launched, meaning there was no pre-mine, there was no pre-sale from the time the contract was deployed on Ethereum, when the initial 100 beans did 100% of the growth in the supply has been, as determined by the algorithm as it normally functions. So how does Beanstalk actually work? Uh, every hour, which in Beanstalk we refer to it as a season. So
Right.
every season, every hour, the Beanstalk price oracle is queried at the top of the hour. And if the price is too high, the system increases the bean supply. And if the price is too low, the system creates soil, which is the willingness to take on debt. And anytime the system is willing to take on debt, so anytime it has issued soil, anyone who holds beans can take their beans and lend the beans to the protocol in exchange for pods, and pods being the debt bearing asset of the system. So anytime the price is below one, and in fact, the system is always willing to issue debt, but specifically when the price is below one, the system will raise the interest rate on the debt. And so by raising the interest rate, the system can basically, or lowering the interest rate if the price is too high, the system can effectively toggle in a somewhat deterministic way the supply and demand for beans. And by every hour taking a sample of the system and adjusting the supply of beans, the supply of soil, so the willingness to take on debt, and the interest rate on that debt, the system can respond to market conditions in somewhat real time, and over time return the price of one bean to $1, excuse me. And the main idea being, and there's a lot of like behavioral economic theory kind of built into this thing,
Sure.
is that over time, as the expectation that Beanstalk will at some point return the price of beans to $1, because it has done so in the past, the expectation is that the market will over time start to closer and closer track the price of $1, and real deviations from the price of $1 will be reflective of actual, like, real increases or decreases in the equilibrium price of beans as a result of changes in the supply and or demand for beans. So really, obviously right now, with the system having just launched a month and a half ago, there is no real expectation at this point in time that beans will return to $1. And so all of the mechanism is kind of on full display and really, being put through the ringer and having to show off its muscle and its design, which ultimately is a good thing. But over time, we expect that volatility will come down significantly and the price will generally track the value of $1.
So yeah, that's very interesting. So obviously, I want to kind of recap what I got from how the system functions, and I think I got it. And the idea is this: is that when the price is over $1, you are increasing supply in order to drive the price per bean down. And the reason for that is that behaviorally, the more of something there is, the less value it has, supply and demand kind of basics. And then when the price gets below $1, you actually are pulling beans out of the market with borrowing against borrowing against the beans to reduce the supply and increase the overall value of each bean to get it back to the peg. Is that basically the whole concept?
Yeah, and maybe just a semantic correction on verbiage, but the protocol is the one that is burning the beans, and
Got
so
it.
in practice, like Beanstalk needs to attract creditors. So
Right.
the only way that in the long run Beanstalk fails is if it is unable to attract credit.
So
But
the number of
ultimately, the way
participants is critical.
the interest rate mechanism, well, exactly. And so the idea being, as long as the system can uh, react by altering the weather, the interest rate, the weather being the name of the interest rate in the system, but by altering the weather, by toggling the interest rate, the system can find a price where it has creditors. So given that the system is like novel and going through its first debt cycle, the expectation is that this is going to be one of the highest interest rates it probably ever has to pay. And over time, as it establishes a decent credit history, the willingness for people to lend to the protocol should improve over time.
That's very cool. Now let's go through let's go through the components of the system, right? And what the experience is of someone who is saying, I want to be a part of Beanstalk. I like this model. It makes a lot of sense to me. What are the ways that they can participate? What are the components of the system called? Looking at the website, I see silo, field, trade, obviously. And then we talked about weather, we talked about soil being the debt market, and I think there's also stocks in the
Lots
market.
of verbiage. Lots of
Yes.
verbiage.
Yeah.
Yes.
So can you kind of
Yeah.
relate each of those components to some things that people might be used to? You've already kind of done that to some extent, but also then in doing
Certainly.
so, let people know how they can participate and why it could be valuable to them to participate. Obviously, no guarantees.
So one of the main design considerations of Beanstalk is like what 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 do people actually want to have if we assume that Beanstalk is kind of ubiquitous. And so the first opportunity to participate in Beanstalk, or benefit if Beanstalk continues to grow, is to simply deposit beans in the silo. And the silo, basically, you can think of it as the bank, but it's really the DAO that controls Beanstalk. And so in practice, this is basically like a simple USD deposit account where you earn interest on your deposits. And this is kind of the base layer of interacting with Beanstalk. So if you have a Bean deposit, you're basically earning passive interest, and there's no action required from Bean depositor in the silo.
Okay.
So if you said, I think this is interesting, you can literally just take exposure to the price of beans, deposit those beans in the silo, and then upon deposit, and this gets into a little bit more of the verbiage, you get stock and seeds. So stock is the ownership token of the DAO. So if you own stock, that entitles you to vote in governance decisions, Beanstalk improvement proposals. So you have a vote in the future of the system. But on top of that, stock is also, the asset that determines how much of bean supply increases you are entitled to.
Okay.
So anytime the bean supply increases, meaning the price was above 1 for a season, over the course of an hour, the average price was above 1, so the system is going to mint more beans. Your percentage, the amount of beans that you are entitled to from that mint is determined by your stock ownership.
Got it.
So the more you deposit in the silo, the more stock that you have, and therefore, the more interest you will earn.
That's awesome. Okay.
So the other asset that I just introduced is a seed, where the only function of seeds, and basically this was primarily implemented as a second asset. Both stock and seeds will become ERC20s and liquid and tradable in the near future. But the reason seeds exist is to create an opportunity cost to withdrawing assets from the silo. So basically, every hour, every season that goes by, every seed that you own yields an additional 1/10,000th of a stock. And so basically, if you're in the silo for an extended period of time, the amount of stock that you will have earned from those seeds goes up linearly. And if you were to withdraw your assets from the silo, you must forfeit all of the seeds and stock that is related to your deposit.
Ah,
And so therefore, people are encouraged to stay in the silo for longer continuous periods of time, and that does create like sort of a base of capital that is going to stay in the system over, even during downswings. So for example, right now, and looking at how that actually has played out during the first debt cycle, about 80% of the beans that were in the silo stayed in the silo during this first debt cycle, which is very exciting given that, in something comparable like ESD, during the debt cycles, almost 90% of the assets, and I am making up that number, but it was a very large percentage of the assets would immediately leave the silo, or in the case of ESD, it was the DAO, because there was no expectation of profit for staying in the DAO with the price below $1.
right.
So this does create much more consistency on that front.
So essentially, it causes a bank run unless there's an incentive, and the incentive that people get for staying in the silos is that they're earning more stock, beanstalks, and what's the other thing? Sorry.
Well, the seed stays fixed, but
Right.
the seeds yield more stock over
Got it.
time. So the
Okay.
opportunity cost comes from the requirement to burn the extra stock.
Okay. Got it. And the people that when at what point is there like a maturity on this where a withdrawal doesn't equal loss of those gains, or how does that work?
You can withdraw your assets from the silo at any time. So you can withdraw there's any time you want, you can withdraw from the silo. In order to withdraw from the silo, you have to burn all of the seeds and stock related to whatever assets you're withdrawing.
Okay.
So there is never a point where you like actually get those stock and you can withdraw it and still hold ownership in the protocol.
Yeah, that makes
But in
sense.
practice, the only liquidity limit on the silo is assets are frozen for 24 hours upon withdrawal.
Okay.
And so this is now going to require us to take a little bit of a leap forward on the technical front, but there's something in the system called a season of plenty, whereby basically if the system has low debt and a high price for 24 seasons straight, so for a full day, the system will automatically mint extra beans and sell those beans on unit and then distribute the Ethereum to stockholders from
Wow.
that sale. And so when you combine the 24 season withdrawal time with the 24 season stop timer, you basically make it so that anyone who's withdrawing from the silo has to make sort of a price independent decision on whether to withdraw or not.
Now I get it. And so it's like a governance token at that point. That's why you're not keeping any of that's coming in, but you're gaining the benefits of the system because you have that ownership in the DAO or the silo, and that's why you're not retaining that when you leave, because you're no longer participating in the system. And then there are going to be built-in bonuses or capabilities because you will be minting more beans when the price remains above $1 for more than 24 hours, and the proceeds of those bean sales will go to those folks that are in the silo.
Yeah, that is generally correct. So,
Cool.
in addition to the simple deposit account where you can deposit beans in the silo, you can also deposit liquidity pool tokens, LP tokens, for the Bean ETH Uniswap pool.
Cool.
And this is obviously to encourage consistent liquidity in the Bean ETH pool. And an additional small incentive to add LP as opposed to just straight beans is that you do get more seeds per bean that you deposit. And so there is a slight incentive to add LP into the silo, deposit LP in the silo, as opposed to just depositing beans. But both are totally viable ways for people to get exposure to Beanstalk. So that is like depositing in the silo is the passive option for players who are interested in Beanstalk. And like we said, there's no action required from silo members. They can set it and forget it if they'd like. And then on the flip side, we've talked a little bit about the lending market, what's known as the field,
Okay.
which is the decentralized credit facility of Beanstalk. And so the field is not a place where there's passive returns. Instead, it's an active lending market. So if instead of depositing in the silo, you want to sow beans in the field, which sowing is lending beans to Beanstalk, all of that
Right.
requires a little bit more of an active maintenance. But on top of that, you can potentially earn, a higher rate of return for being an active participant on the debt market side.
So in terms of the lending process, the field process, I could buy beans, deposit them in the field, and then the protocol would borrow against it when the price of bean is below $1, and I would earn whatever the current weather rate or interest rate is at that time against those that I had deposited in the field. But when the price is above, I'm not earning anything from it. So that's kind of why there's like a more active role for someone who's investing in that way.
So generally correct. A couple things to clarify is if you lend money to Beanstalk, you only get paid off when the bean supply grows. And so everyone who is a member of the ecosystem really receives their interest when the bean supply is growing. But
Okay.
the underlying dynamic and economic incentives and structure around lending beans to the protocol is sort of fundamentally different than depositing assets in the silo. So to walk you through a little bit of how that works, the terminology, just to restate it for clarity. So soil is the willingness to like borrow beans. So anytime Beanstalk has soil in the field, it says if there's a million soil, Beanstalk right now is willing to borrow up to 1 million beans.
Okay.
And the interest rate Beanstalk will offer to borrow those beans is the weather. And so the weather changes every season based on supply, the price, the debt level, and demand for soil, and changing demand for soil specifically. But the idea being that by changing the weather, we can toggle the interest that people may have for lending beans to Beanstalk.
Sure.
So the economic structure is if I lend beans to Beanstalk right now, Beanstalk immediately burns those beans that I lent to the protocol, and in exchange for sowing beans, I get pods. And again, pods are the debt asset of the system.
Okay.
So pods, unlike stock, which, just to reiterate, stock is paid pro rata every season. So if I have 1% of the stock, I get 1% of the payments to the silo.
Okay.
Pods are paid on a first in, first out basis. So the sooner you lend money to Beanstalk, the sooner you get paid off. So there is, when we talk about behavioral economic incentives, if we think about like an individual participant of the system deciding, should I lend money to Beanstalk or not, if the weather is high enough such that I feel like this is a good time to lend money to Beanstalk, I am incentivized to lend money to Beanstalk immediately. Because if not, someone else might, and I will move back in the pod line and my overall return will go down. And so when you compare this to something like the debt mechanism in ESD, this is like a primary example where we think we've solved or are solving for some of the tragedy of the commons issues that were present in something like ESD, where, just to state the specifics, the interest rate for lending ESD to the protocol was determined by the debt level in the case of ESD. And so obviously, like, someone lent money to ESD raised the debt level and therefore also raised the interest rate of the next participant.
Huh.
So there was this real tragedy of the commons issue where everyone was kind of waiting
For
for the
somebody
debt
else to
level
do it.
to go high enough Exactly. And this created a problem where at the beginning of each debt cycle, you had like a pre-forecasted and an easy to understand reason why the price was just going to tank. And so that ultimately is something that in the case of Beanstalk, we think that there's a much, much, much more efficient market for the debt in Beanstalk than there were in previous algorithmic stablecoin attempts.
Yeah, makes sense. When I deposit and lend to the protocol, so I'm looking at the website right now, right? It shows weather at 419%.
So just to clarify, so depositing and lending are the two sides of the coin. So you
Sorry,
either deposit or you lend. You can
lend.
deposit and lend, but they're
Right,
two different.
right.
Yeah, just to clarify for everyone.
Yeah, I think that for the reason I keep mixing it up is the action of actually saying, okay, here's my coins to lend to you. It feels like a normal, like a deposit action in the interface. So lending to the protocol, it shows currently weather's at 419%. From the perspective of someone who is coming in and saying, okay, this looks like an opportunity to earn and to help the protocol get back to its peg. What's the experience like for them? So let's say I put in 1 ETH right now, and that would equal 33,730 pods. I lend to the protocol, and then the process is how long should I leave that in? Is the 419% an APR, an APY rate? Can you kind of relate to people what they're used to in other lending scenarios, what they should expect if they were going to participate?
Definitely. And this is a little bit of a new and unique experience. So this is a good thing to focus on. So the weather, it is the only thing that determines your rate of return.
Mhm.
And so just to clarify, so you asked, how do you do it? So on the website, bean.money, you can actually lend beans to Beanstalk directly from Ethereum. So in one transaction, you buy the beans, you send the beans to Beanstalk, Beanstalk burns the beans. That
Right.
can all happen instantly. And in exchange for however many beans you lend to Beanstalk, let's just stick with a simple example. If I lent 100 beans to Beanstalk and the weather is 419%, I am going to get 519 pods. So for each bean that I burned, I get 1 pod back, and then I also get plus however many beans I burned times the weather. So in this case, it's 419 additional pods. So that you immediately lock in what your expected return is.
Wow.
So
Okay.
at that point, the 519 pods that I just got go to the back of the pod line, which right now I haven't checked in a little bit, but it was something like 7 million pods.
Yep.
And so in the future, when the system pays off all of those pods in front of you and then pays you off, you will then have 519 harvestable pods. And when you harvest your pods, you basically redeem them 1 to 1 for beans. So once you've completed a full lending cycle, you lent the beans and then you harvested the pods, you'll have taken your 100 original beans and turned them into 519 beans. And
Nice.
obviously, this is changing over time based on the weather, which changes every hour.
Got it. Okay. Now that makes total sense. So, in terms of someone kind of saying to themselves, okay, how long am I putting my 100 beans? How long am I waiting for my 519 pods to come back that I can exchange for beans? What's the, if you have seven right now, we're at 7.52 million in the pod line. What kind of is the expected timing on the return? And is the pod line a way to throttle, exchanging and dumping? If is that kind of its purpose, is to make it so not everything is coming out at the same time and being sold? Is that kind of part of the reason for way the pod line works and getting your return on your lending?
So there's a couple different things to answer here. One is that the first in first out pod harvest schedule is primarily a behavioral incentive where you are incentivized to sow your beans as soon as the weather
Possible.
is sufficiently high and you deem this as a sufficient return.
Right.
Um, in terms of payouts, so let's go back to kind of a high level view of the system. Let's say that the price is too high and the system is going to mint an extra 100,000 beans this hour, half of those beans go to silo members, and half of those beans go to paying off pod holders.
Got it.
And so in practice, what happens is anytime pods are harvested, they will be harvested with the price above or just about one.
Got
And
it.
so the idea being that, especially like right now, with the price at about 50 cents, you can buy two beans for every dollar. You can sow those beans and get a 400% return on both of those beans. So it's really like double that. And then when you have the opportunity to harvest your pods and sell, almost guaranteed you'll be able to sell it over a dollar. And if not, you'll basically be at exactly a dollar.
Yeah.
And so, to answer your specific question on the time or the duration, there's no guarantee as to the time for when the pods are harvestable. Beanstalk will never default on pods, but there's also no time that the pods expire. And so, there's no risk of default necessarily, but the exact time until you get paid off is not determined. So, this goes back to the different opportunities in the system. You can have 24-hour liquidity in the silo, or you can have illiquidity in the field, but typically the field will offer you a higher rate of return for that
Sure.
illiquidity.
Right. So now I get it. The pond line reduces when beans are over a dollar, right? And that's when the minting happens, and that's when the beans are given to people that were in line on a first come first served basis. And you're right. The beauty of it is that right now with the current price of 50 cents and the weather at 419%, it's a pretty attractive investment. And you're also, as a community, incentivized to continue to help the protocol get back to a dollar in order to see the gain that you've had on your lending investment. Am I correct on that?
Yeah, that's all correct. And as you can probably tell, each of the different participants in the system all have their own unique incentive structures that are designed to facilitate people to, without direct coordination, but to get everybody to be in line with the general interest of the system. So, you can't dictate what people do, but you can offer them incentive structures that hopefully facilitate the type of behavior that the system wants to see.
Right. Absolutely. And so, yeah, no, I mean, it makes complete sense. And look, everything in life is based on incentives. So I think the model here makes a ton of sense, a lot of sense. What else should we know about how the system functions, or the opportunities for participation that you'd like to make sure people understand and are aware? By the way, you guys did a great job on the interface. It's really nicely done, elegant, smooth, clean.
Well, we really appreciate that. Not to over pontificate, but we really have taken this seriously, and our main focus and our main goal in how we have conducted ourselves throughout this entire process are certainly, over the past 6 or 7 months, once we decided that we were going to do this thing really the complete and right way, is to put Beanstalk in the best position to succeed as this as the stablecoin protocol for DeFi. And so part of that is making a user interface that is somewhat easy to use. Obviously, there's a steep learning curve when you first come to the protocol. So, there's a how-to guide and step-by-step instructions and a lot of supplemental material. But in terms of what else, we'd really like to highlight, other than, the focus on making this work in the long term, is that the system is going through right now, like really through the ringer, in the sense that, we didn't have any marketing or any sort of big launch, just to juxtapose it with something like Fay, which had over $1.5 billion committed to the protocol before they launched. We basically decided to go the radically opposite route and start it at really zero. And the main reason for that is a protocol that requires lenders also needs a credit history. And so the idea being that if we started at 100 million or $1 billion supply, and now the price tank's 10%, like good luck finding $100 million of creditors if you're a brand new protocol with no credit history.
Yeah.
So instead, we really did start small and organically, and just to give people who are probably looking at the price charts over the past week or two and saying, well, what's going on? So the system basically a week and a half ago kind of blew up. And we don't even really know necessarily where it first kind of caught the eye of the public or crypto Twitter. But in just a few hours, the system went from like a $2.5 million market cap to over $40 million. And obviously that type of volatility is a lot for a new stablecoin protocol to handle.
Sure.
And that was perhaps exacerbated by, and this did put a big smile on our face, but one of the Discord community members basically said something along the lines of, once all of the people that were aping into the protocol realized there was no way for them to easily extract value from the protocol, they quickly left because they realized they couldn't game the system effectively. So on the one hand,
That's
that's a
awesome.
very good sign for us that the protocol is
Yeah.
working as intended. But on the other hand, $8 to $10 million of capital flowed into the protocol very quickly and then flowed out of the protocol just as quickly. And so now the system is, and ultimately the joke is, even though this wasn't how we drew it up on the big board, it is certainly like an incredible thing for the system to go through and prove that it can survive basically anything. Because going forward, the idea of having a similar type of volatility at like, a $20 million market cap where we'll probably settle towards the end of this debt cycle, even if we took in $20 million, you wouldn't have anything close to that type of volatility. So this is really like a huge test and also a huge opportunity for the system. But in general, we're incredibly thrilled by the functioning of the system, the response of the weather to the current real time situation in the system, and most importantly, the system has attracted, as you just said a little bit before, 7.5 million POS. So when we talk about the system issuing debt and attracting creditors, it seems that there is, and if you can look at the growth of the pod rate, the pod line over time, like every day over the past couple of days, there's been a major increase in the amount of money that's been lent to Beanstalk, which is very encouraging. So, when we think about where we actually are in this cycle, immediately after the system kind of blew up and spiked up to as high as $4, there was pretty consistent withdrawal activity from the side where there was over 2, sometimes 3 million beans being withdrawn from the silo every day. And the system, obviously the price went down significantly as that was happening. But 2 days ago, the withdrawals finally fell below $1 million. And then yesterday, they fell below $500,000. And today, they're as low as something like 300,000 beans. So the withdrawals have almost entirely stopped. The people that are still in the silo have more opportunity cost to leave now and seem to be, here for the entirety of the cycle. And the selling has effectively, dried up. And as is evidenced by the price action over the past 36 hours or so since the withdrawals really dried up, there is demand for beans, there is demand for debt, and it's just, a question of, how the system, how quickly the system is able to attract new lenders. But it seems that the system is doing that effectively and somewhat efficiently as well, even during its first major test.
Yeah, that's actually pretty awesome. I gotta believe. I mean, I know you guys obviously you thought through this thing quite a bit and modeled out how it would function. But I have to also believe that there was like this mix of excitement and dread when all this money piled in, because it wasn't really what you wanted yet, I'm assuming, based on kind of what you just talked about, because you had this nice steady line of maintaining the peg, and then suddenly there's this massive surge. And on one hand, you're like, oh God, I'm sure you're thinking through, did we do everything right? But on the other side of it, it's like this awesome test of, yeah, did we do everything right? And it looks like, maybe we did, and things are functioning the way they should. Was that kind of like what the experience was like for you guys over the last week?
Well, it really was surreal. And on the one hand, there was immense jubilation that there were more eyes taking a look at the protocol. And
Sure.
obviously, it was very exciting to see a generally positive reaction to everything, and our families are calling us, "Oh my God, what's happening?" The whole 9 yards. And ultimately, having seen the way that these other algorithmic stablecoin attempts go through cycles, and B, having designed the whole protocol, our advice to everyone who called us was basically like, you know, the real test is just getting started.
Yeah.
So on the one hand, it was very exciting, but on the other hand, this is, and not to be overly academic, because we are not academics, and don't pretend to be. The system really was designed, in theory, to handle anything you want to throw at it, and specifically anything you want to throw at it.
Right.
Like when you think about attack vectors, like one of the potential attack vectors is to artificially inflate the price and then try to crash the price. And so, like, this isn't something that was uh, not only not planned for, like, this is expected. Like, if anything, this is what the protocol is designed to handle. So the fact that
Right.
the test is just so large, because the order of like, there was literally 4 or 5 times the total market cap of the system that came in just a few hours. Like, the test is a big test, but at the same time, and we don't say this lightly, Beanstalk is designed to be resistant to attack from governments. It's designed to be resistant to Soros type attacks. It's designed to be resistant, period. So it's just very exciting to see, and to also have the opportunity for Beanstalk to show that even in such an infant state, even with such an unsustainable period of growth for a couple of hours, even with all of that capital immediately leaving the system fights on, and the system lives to fight another day, and eventually the peg will be returned. And at that point, the system is going to be in a really, really, really good position moving forward. And that's what excites us now.
That's awesome. I'm excited. That's actually really cool. On the decentralization perspective of this thing, are you guys kind of taking an approach of deploy and your hands off, or how much control do you have over things as this thing progresses? Did you kind of maintain some admin control to be able to still tweak things or handle any problems that might come up?
So the short answer is yes. Like, currently, the deployment address still has unilateral ability to modify the Beanstalk contract, and
Uh-huh.
that has come in handy. There have been, especially as the system blew up over the past couple of weeks, we had a large, set of bugs that were reported. Only two of them turned out to be actual issues with the contract. Both were minor. There was like a total of less than 5,000 beans or so that might have been misallocated, but it was a very quick fix. And those are the types of things that, for the short term, are the reason why the deployment address still has the unilateral ability to modify Beanstalk. But Beanstalk was implemented as an upgradable diamond, and through a BIP, through a Beanstalk improvement proposal in the future, our hope and our expectation is that the community is going to remove that ability from us in the future. And when you ask about kind of what's our mindset on being hands off or being hands on, you know, this is a deeply pivotal time for Beanstalk, in the sense that, the quality of the community and the quality of the discourse that is happening around the future of the project, and the ability of Beanstalk to attract high quality developers and other high quality, minds in the space, and to potentially make the pitch that Beans should really be adopted as the stable coin that is used across DeFi. There really needs to be a high level of faith in the protocol itself. And so, in addition to obviously like resistance from, being strong armed by governments, another reason we like being anonymous is that it does really provide the opportunity to, not necessarily immediately, but in the near future, transition this to a primarily community developed and community run, protocol. Our goal is not to be, and it's not about hands on or hands off. Our goal is not to have everyone reliant on it to keep Beanstalk going. Our goal is for Beanstalk to keep going because Beanstalk is sufficiently well designed and has a sufficient pool of supporters and creditors behind it, that we don't need to be there.
Right.
So it's not an exact science as to how to make that happen, or when to lower how much we have to do with the protocol. Right now we're still in the process of putting out supplemental materials, and doing an interview like this. This is our first such interview, but things like this are really meant to bring this to more people, bring this to more eyes and ears, and hopefully facilitate that, transition away from being dependent on Publius. But, we did just get started 52, 53 days ago or something. So, Beanstalk remains young.
Decentralization never is instantaneous, or rarely instantaneous. So no, I totally get that. Here's something I'm kind of interested in. It sounds like you've already built kind of a strong community, and this is something I think is actually interesting about this. When I first looked at your website and then started going through the documentation, I found a bit of a disconnect for me in terms of the nomenclature, the terms that you use to describe the different components of the system. And my initial kind of traditional concern from a marketing or business development perspective on that is what that means is that you potentially lose out on some users who don't go through the work. But as we've talked through the system, I actually am starting to believe that, and I haven't really jumped into your community to take a look yet, but I'm actually starting to believe that actually is could be a feature of the system. And by that I mean is that I think that obviously community is critical and you want people engaged with it. And there's a level of investment required to get conceptually how things function with Beanstalk. And so I'm wondering if you're seeing that reflected in the community as it's growing. Are you seeing that the people who are participating and are enthusiastic about the protocol are people that are more likely to stick with it because they've invested the time to conceptually understand it?
Well, the short answer is definitely. And one of the ways that we really like to live our lives, not just with regards to Beanstalk, but in general, is you try to act in a way that, like, you put people in a position where, however they act, you're comfortable with the outcome. Ultimately, people are going to do what they're going to do. But in the case of Beanstalk, the real goal is to attract people that are curious and people that are really interested in putting in the time. And I don't say this lightly, but the people that came in and then quickly left the system last week are kind of the opposite, who never wanted to. And granted, us, some percentage, and it's certainly non-zero, of the money that came in last week does fall into that category. And those are the people that have stuck around, that have done their research, that are now, still in the system. When you consider, the ultimate, the market cap was 2.5 million before the system pumped. The bottom was somewhere around 5 million or a little bit above that. So you do consider, like, there was still a major growth in the community. There was still a major growth in the value of the system and the capital invested in the system. But we're not, Beanstalk is not interested in just being another throwaway project. Beanstalk is designed to set precedent for the industry. And part of setting precedent is, and it's not about, oh, we wanted to be original and we didn't want to do everything the way other people did it. We realize that and recognize that there's an opportunity here to set the standard for the industry with regards to stable coins going forward. So, using an epic as opposed to a season, it's all just nomenclature. But at the end of the day, it's actually so much more than that. And it's a real litmus test for the type of people we're hoping to attract.
That's great. Yeah, I think that makes a lot of sense. In terms of, look, I think one of the things that happens in looking at a project like this, right? People are in DeFi to turn some money into more money, or I'm very similar that way, right? My initial attraction into crypto years ago was, oh, there's an opportunity to make some money here. And then once I dove deeper and understood conceptually what I was getting into, it became much more about how do I make sure that the whole world operates on these kinds of principles of freedom and decentralization. And that becomes part of what you're doing. And I think that there's a similar thing here, right? There's an opportunity in this project for people to come in and make a lot of money and then become true believers or participants in the DAO and in the project overall. Do you think that there's a risk with algorithmic stablecoins in general that once a project has proven itself and is functioning well, Do you think that as the kind of individual returns that can be gained leave you with just a hardcore group of people that just like the project and what it does for the ecosystem, and it's more motivation? The motivation is less about making more money and more about just changing the system? Or do you foresee that along the lines that over time that people will still be able to kind of earn from the protocol and participate because they want to see a better algorithmic stablecoin and they want to see a better source of money?
Well, I'm going to kind of go a third route of answering this and not accept either of the two options you
Nice.
presented, which is it's not necessarily exclusive. So, right now, obviously, with a $10 million market cap, and you can look at this and say, well, if this thing works, it's a 10 billion, $100 billion. You look at the supply of other US stablecoins, there's obviously right now a much higher potential return than if you deposit into the silo at $1 billion market cap.
Right.
However, there's two separate things to focus on here. One is that the type of capital that would be interested at different sizes is kind of built into the growth model, meaning that as Beanstalk grows, it should attract like a different set of capital
Right.
in the sense that, there's all sorts of different participants in the DeFi ecosystem, and they all have their own unique risk return profiles. And so, in line with the overall potential return that you can earn from Beanstalk going down, that will also go hand in hand with Beanstalk no longer being a brand new protocol that's never been through a debt cycle and has no consistent credit history. So over time, your return may come down, but your risk may also come down significantly.
Sure.
And then the second prong to this is when you consider what we're actually setting out here to do, which is to have Beans adopted as kind of the base stablecoin of all of DeFi, there's a lot of utility that isn't even accounted for here. So, like previously, we've just been really talking about and envisioning how does the own internal mechanisms of Beanstalk enforce Beans to return to a peg, but that doesn't even account for over time. There really should be, especially if Beanstalk can establish that it will return the price of one bean to $1 over a period of time, there should be real demand, organic demand for beans that comes from people that don't want to deposit in the silo or sow beans in the field, but instead want to use beans across DeFi. And so that really becomes where, it's not necessarily about how does the change in return affect, the people who want to participate in the system. That's like the best problem to have because that means the system is working effectively.
Beautiful. Love it. So I think that makes complete sense, and I love that answer. I absolutely do agree that you'll have a different type of people participating when the risk reduces and the gains reduce. And I think that's evident in other protocols in DeFi. Over time, there's a shift from kind of aggressive, thrill-seeking early adopters, fascinated with the whole thing, to people who are more risk averse and so see something that's stable and functioning and integrating in the DeFi world as a whole, and they see the value in that as well. In terms of, look, it's you've already got great success in a very short period of time in terms of proving the protocol and getting people engaged with it and seeing that it's functioning the way you had hoped it would function, right? And I think that's phenomenal. But then I guess the next big step for you is, are you as a team or as a DAO planning to go out and really start working and trying to engage with other projects for integration and for use of Beans within their protocols? Kind of what's your approach going to be to kind of growing and seeding Bean throughout the DeFi ecosystem?
Yeah, that's a really great question and something that we feel like there's a right way and a wrong way to go about this. So many protocols in DeFi have these large treasuries, which we find to be incredibly inefficient uses of capital, and they end up just kind of sitting there and are almost always either not used, underused, or misused.
Right.
And so, our basic philosophy on this is, especially as Beans, returns to a peg and completes its first major debt cycle over the next week or two, God willing, the hope is that through specific BIPs, Beanstalk improvement proposals, the protocol can, fund additional development on Beanstalk. So the hope is to use BIPs to facilitate and fund developers to join the team, continue to contribute to Beanstalk. And then specifically this model, instead of like an omnibus treasury model, this also is directly applicable to incorporating with other projects. So if there's a protocol that wants to incorporate Beans into it and there's some added complication, through a simple BIP, we can fund that. And the idea being that the community and the DAO can have an effective control over where the specific assets are being spent and on what projects and how to incorporate it. But generally, given the interoperative nature of Ethereum and DeFi and the ease of integrating another ERC20 standard token, our expectation is that a lot of that integration is going to be driven not by, paying for it, but as much as just demonstrating utility. And as soon as this Beanstalk does demonstrate that Beans are a reliable, truly decentralized algorithmic stablecoin that is valued at $1 over time, our expectation is that there, we go back to the auger example, there's a natural incentive for a lot of these protocols to add Beans to their protocol. So step one is completing the first debt cycle. At that point, given that the system will really be at some sort of equilibrium, our expectation is that volatility will come down for a period of time, and at that point, that becomes kind of the first major opportunity to start actively doing some of that, development, and potentially also, starting to directly incorporate with other protocols.
Any plans for direct layer 2 integrations, any, Polygon, any of the others that are out there now, other chains, any thoughts on that? Or are you guys going to stick strictly to mainnet for now? What are your thoughts around that?
So the conversation around layer 2 and different networks are related but separate.
Right.
In general, we really do want Beanstalk and like basic US dollar deposit accounts to be accessible to everyone, even if they are, really smaller silo members. And that's very important to us. But at the same time, one of the main things that really must be part of Beanstalk is censorship resistance and decentralization. And so, to start with these layer 2s, and they really are doing some incredible things. We're actively watching those protocols, and as we feel much more comfortable in their level of decentralization and their resistance to attack, that becomes something that's very interesting to pursue in some capacity. But as of now, we're not in a rush to do that, and our main focus is just having Beanstalk establish its economic mechanism fundamentally works. But with regards to other protocols and even depending on the specific implementation of the layer 2, in most cases, let's say that someone wanted to issue, a US dollar Bean on Solana, just to give an example, like the economics basically dictate that what is much more likely to happen than some sort of like cross-chain bridge is to actually have a separate, totally independent Beanstalk on those other chains that issue their own assets, have their own funding rates, have their own kind of mini ecosystem. But if the granddaddy Beanstalk, the original Beanstalk on the Ethereum mainnet continues to hold its dollar peg, that should really be, kind of a nice tailwind to help some of those other Beanstalks get off the ground. But that's not in our immediate plans. If you look at the white paper, that's consistent with the original vision, and that remains the vision. But at the moment, goal number one is just having Beanstalk continue to develop a strong community, and as part of that community development, returning to a peg. And that's more of our focus than layer 2. But everyone is actively asking about that, and it's definitely, it's important to us to make this more affordable going forward.
Sure. Yeah, I mean, look, I think for smaller investors, it's tough to do mainnet these days, and so I definitely can see why you'd be getting pushed for that. But it also makes sense for you to build and stabilize and prove what you want to prove. I don't mean for proof's sake. I mean prove that it functions so that people can trust in it and you can expand its reach. And it makes sense to start where you are and not try to expand too much into other layers or other protocols right away. Is there anything that we haven't covered about Beanstalk and the protocol that you really think we should talk about?
I think we've kind of covered all of the basics. Maybe one last thing to highlight
Uh-huh.
is that the stock ownership from seeds, if you think about how that is dilutive, uh, really is designed to increase the decentralization of the ownership of the protocol over time, because anyone can, and this is specifically, we want to highlight that this is not a seniorage coin. There's no seniorage token. There's no early group of investors that basically have this unlimited upside on the growth of this protocol that they seeded. We think that's fundamentally wrong.
Okay.
And instead, by having the ability for anyone to get their stock and seeds by purchasing beans on the open market, and then the way that your stock grows over time, and which is effectively non-dilutive, it's slightly dilutive to bean deposits over LP deposits because LP deposits get more seeds.
Right.
But the growth of stock over time, the primary function isn't to dilute people, it's to encourage people to stay in the silo. And then when you consider the way that anyone can mint their own stock and seeds, it really is a model that should lead to much more decentralization of the protocol over time.
I think people like mission driven, and I think it sounds to me like Publius is incredibly mission driven for censorship resistant and decentralization. And so I think it bodes well for your success and your growth. I always ask everybody that comes on the show, are there people and or projects in the space that you have a ton of respect for, or that people should be watching, either people that we know about or people we don't know about, or people that in your particular case that are really kind of mission driven, you believe the way you are and are delivering on that? Are there people or projects that kind of fit that for you?
We're going to take a little bit of a cop out here, at risk of, or really to prevent the risk of offending some. The building decentralized protocols is really, really difficult because at all points in time, there's an opportunity to cut corners, and to not cut corners and to kind of stick with the original vision. And obviously the vision needs to change in line with new market data. We are kind of continuously going to propose updates to the stability mechanism, although they're generally minor updates. They're updates nonetheless. When you talk about, do you want to give, like, are there people that inspire us in the space? Like, we are so deeply inspired by, like, if you really think about the story of the founding of Ethereum, the way the team was, eventually had a lot of problems. There was the DAO hack. Now you have Charles Hoskinson building his own network. When we look at all of the things that went wrong, and still you have this incredible network that is decentralized and is supported by, like, a wide variety of teams. I think that's one of the best things about Ethereum, is that Ethereum v2 is being developed kind of in tandem by lots of different teams, and they're coordinating, but they're also somewhat competing. That's what inspires us, and that's one of the reasons why we ultimately were building on Ethereum. But that's also what we aspire to have happen to Beanstalk, where there's a deeply, variant and diverse community, but that all of the different members of the community, even if they disagree, believe that Beanstalk is going to be a real factor for positive change, both in DeFi and in cryptocurrency and in the world in general.
I think you answered the question and didn't cop out at all. I mean, I think that that's something that, I tweeted earlier today, somebody who was working on some ZK rollup stuff all on their own and published their paper about it. I love seeing the participation by this incredible, diverse community of people who are just driven to make it better all the time. And I think that's a great answer.
It really gets you fired up, doesn't it?
Totally does.
It really gets you fired up.
It's incredible to see what people are willing to do to drive the whole thing forward. And so, yeah, absolutely. I think you had a great answer there. I think that's perfect. So how should people reach out, get involved? What's the best way? Should they just go to the website? What would you guys like to see them do? Twitter, all that?
So, to participate, you should just check out the website bean.money. But, in general, if this is something that interests you and you want to learn more or join the community, our Discord is very active. So check us out in there. And, the link to that is on the bottom of the website. And, the email on the white paper is an email address if you really want to go in the email route. But we're accessible, we're here, and we are determined to make this a success.
It's great to get to know you guys and great to hear more about what you're building and get a much better understanding of it. I'm very excited for you.
Well, we really appreciate your time, Brad, and thank you for having us on and sharing your platform with us.
Absolutely. I've worked with a lot of startups in my career, and I never get tired of working through the excitement and the danger and the ambition that they all bring to the table. And it's a lot of fun. And I'm excited to see where Beanstalk takes this. They're obviously motivated, mission-driven, and excited about what they've built. And they seem to have really planned for what they think is coming next. We'll keep an eye on them and get back to them in 6 months or so and just see how things are going. Thank you for listening. Please rate, review, subscribe, tell your friends, share it on Twitter. Anything you can do to help us spread the message of financial freedom and innovation in DeFi is greatly appreciated. Have a great day.